Welcome back to Investing Talk podcast. Today we're taking a close look at a technology company out of Sweden, Neonode, ticker's NEON. You sent us quite a bit of information here. We've got the overview, recent performance, financials, strengths, weaknesses, market sentiment, competition, future outlook, even some recent news and, a deeper financial snapshot. So our mission today is really to unpack all of this and get to the core of what you need to know about Neonode.
Okay, let's get into it.
Let's do it. So first off, what exactly does Neonode do? They started back in 1997, based in Stockholm. They specialize in optical sensing solutions. Think human-machine interaction.
Right, HMI stuff.
Exactly. And their key platform is called zForce. It's for advanced touch and gesture recognition. What's kind of interesting is they aren't just stuck in one industry. They're in office equipment, automotive, industrial automation, even medical.
Okay, quite diverse. And we've got some recent data. It looks like up to April 2025.
Where? As of April 25th, the stock price was sitting at $11.05. Now, we don't have detailed price charts here, but the info suggests, well, pretty strong growth potential. There's a projected revenue increase of almost 44% for 2025.
Wow, 44%. That's significant.
It is. And maybe more telling, their current revenue growth rate, around 19% per year, is actually outpacing the U.S. market average right now.
Okay, that's a key point. Growing faster than the market.
And the expectation, or maybe the hope, is that Neonode will hit profitability within the next 3 years.
Right, that 3-year timeline for profitability, coupled with that faster than market growth.
Yeah.
This does paint, an optimistic picture. It suggests their tech or their market approach is gaining some real traction.
So digging a bit deeper, definite strengths to note, that zForce technology you mentioned, that seems like a real asset, opens up licensing revenue, which is interesting.
Yes, the licensing angle is crucial.
And being in those diverse markets, like you said, that helps reduce risk, spreads the bets a bit. But that profitability timeline within 3 years, that's definitely something you have to keep in the back of your mind. It's not profitable now.
Correct. It's a forecast to target.
Yeah.
And recent news I saw even pegged them as a potential top European tech stock this year, based on these strategic moves they're making.
Yeah, that buzz is out there. What about the tech itself, the zForce? How does it differ from, say, the touch screen on your phone?
Good question. It often uses infrared light beams just above a surface. When you touch or gesture, you break those beams. So it can be touchless, which is great for hygiene in, say, medical settings, or it can work with gloves in industrial settings. It's different from the typical capacitive screens.
Ah, okay, so potential advantages in specific environments. But that potential needs to translate into profit eventually.
Precisely. How effectively can they leverage that tech and that market diversity to actually hit that profitability target? That's the key question.
Right. And they're not alone. Let's talk competition. They're in the electronic component space, up against companies like Synaptics, Goodix.
Those are definitely players in the touch and gesture recognition field.
So where does Neonode fit? What's their edge, if they have one?
Well, it seems to be twofold. First, the specific capabilities of zForce, like we just discussed. Second, their strategy. They seem focused on licensing that technology out rather than just selling chips or components directly.
So Synaptics and Goodix might be selling more direct hardware solutions.
Often, yes. They provide integrated circuits, full solutions. Neonode's licensing model lets them partner with manufacturers across different industries, embedding zForce tech without maybe the same direct hardware competition. It could give them more flexibility, maybe reach into niches where zForce offers a specific advantage. But, the question is the tech compelling enough to win those big licensing deals?
Okay, that makes sense. Now let's shift to recent events. Big changes at the top, it seems.
Yes, quite significant. In March, Daniel Alexis took over as president and CEO. He came from Ericsson.
Ericsson, okay. So telecoms background, but likely broad tech and B2B experience. What's the stated goal?
Seems to be a much stronger focus on licensing their tech, specifically into automotive and industrial sectors.
Right, doubling down on those areas. And there's more, isn't there? Someone joined the board.
Yes. In April, Didier Schreiber joined the board. He's described as an automotive veteran, previously with Rondine Group.
Okay, so CEO with Ericsson experience, board member with deep auto ties. The message seems pretty clear. They're really pushing towards automotive.
It certainly looks like a very deliberate strategic pivot towards automotive partnerships and licensing deals in that space.
And they even got an award late March.
They did. An industry award for innovation in automotive HMI solutions. Human-machine interface.
Right, HMI. What kind of innovation are we talking about there? Touchless controls in cars, gesture stuff.
It likely relates to making the interaction with the car's systems safer or more intuitive, possibly using their zForce tech for unique gesture controls or more robust touch functions than standard screens offer. It plays into improving the user experience and safety.
Interesting. But, okay, despite these positive strategic moves, the recent financials tell a slightly different story, right? Fiscal year 2024.
Yes, there's a bit of a disconnect there, or maybe just a transition lag.
Mm-hmm.
Overall revenue for FY 2024 actually decreased, down about 18.8% compared to the year before, landing at $3.1 million.
And the main reason?
Primarily a decline in license sales. Their core licensing business seemed to shrink.
Okay. That's not great if the strategy is moving towards licensing, but there was a bright spot.
A very bright spot, numerically at least. Revenue from engineering services shot up massively, over 1,500%.
1,500%? Wow. What drove that?
It was linked specifically to projects in the commercial vehicle space.
Okay. So, while core licensing dipped, these specific, perhaps non-recurring engineering projects surged. It really highlights where their immediate focus, or at least recent success, has been.
Exactly. It underscores that this business model shift is very much in progress. And maybe right now they're heavily reliant on these specific engineering contracts, perhaps as a lead into future licensing.
Could be. And the market seemed to react positively to all this news, the leadership, the award, maybe even those project wins. Stock jumped.
It did. Over 8% on April 25th, closing just under $11. Likely optimism around the new leadership, the strategic direction, and those wins in niche areas like driver monitoring systems for commercial vehicles.
But there's a caveat, right? Small company, potential volatility.
Yes, one source rightly cautioned against, reading too much into short-term swings like that. It's pretty typical for smaller companies undergoing big changes.
Makes sense. So that stock jump. You have to ask yourself, how much weight do you give that short-term reaction versus the underlying financial picture, especially during a transition?
That's the critical question for any potential investor here.
And this focus, you mentioned driver monitoring systems, DMS, that seems quite specific.
It is, and it aligns with a growing need, especially in commercial vehicles. Think regulations, like the EU's general safety regulation. There's a mandate driving demand.
So they're not necessarily going head-to-head with the big guys dominating DMS in passenger cars.
It doesn't seem like it. It appears they're targeting these more specialized, perhaps underserved, niche markets within commercial vehicles, a potentially smarter way to enter a competitive field.
Okay, strategy seems plausible, but let's talk risks, because there definitely are some.
Absolutely. Number one is that declining core license revenue we saw in the FY24 results. If the future is licensing, a recent decline isn't ideal.
Right, and reliance on just a few key OEM clients? Is that an issue?
It can be, yes. Customer concentration is always a risk. If one big client leaves, it can have an outsized impact.
And cash burn?
Also a factor. They burned through almost $6 million in cash last fiscal year. When you're not profitable, managing cash is critical.
Okay, so declining core licenses, client concentration, cash burn, those are significant hurdles.
They are. But on the flip side, you have the opportunities. Those engineering projects, even if non-recurring now, could they scale? Could they lead to bigger deals?
And the new leadership with their connections.
Exactly. Can they leverage those networks, particularly in automotive and industrial, to land the new significant licensing agreements that the strategy depends on? That's the potential upside.
Looking at the financials a bit more broadly then, that 2024 revenue decrease really reflects this shift away from perhaps older models towards this licensing focus.
Yes, it's the picture of a company in transition.
They reported a loss per share of $0.37, slightly worse than the previous year. And obviously, since they're losing money, a standard price-to-earnings ratio just doesn't apply here.
Correct. PE is meaningless without earnings.
One slightly positive financial note, maybe they used a bit less cash in operations in 2024 compared to 2023.
That could be a small positive sign, yeah. Maybe indicating slightly better control over operational spending during this transition period. Doesn't solve the cash burn issue, but shows maybe some discipline.
Okay. Their competitive advantage fundamentally seems rooted in those tech platforms. Multi-sensing, zForce, they are apparently generating customer interest.
That's what the material suggests, yes. The tech itself seems capable.
But, and it's a big but, they're trying to license this tech in a market where there are already bigger, more established players also vying for those deals.
Right. Translating that customer interest into actual signed revenue-generating licensing contracts in a competitive field. That's the real challenge ahead.
And for a complete financial picture, we're missing some pieces here, like specific debt-to-equity ratios, price to book.
Correct. For those details, you'd absolutely need to dig into their official SEC filings. They aren't in the sources we reviewed today.
And no dividends being paid out currently?
Which is totally expected. They're in a loss-making phase, trying to pivot their business. All available cash is likely going right back into funding that transition and growth efforts.
Okay, so wrapping this up, what does it all mean for you, the listener? Neonode seems to be at a really interesting, maybe critical inflection point.
Absolutely. They're pivoting hard towards what they hope are higher margin licensing deals, particularly in automotive and industrial.
The new leadership, those recent project wins, they offer some validation, some signs that this could work.
Potential green shoots, yes. But you absolutely cannot ignore the current reality. No profits yet, declining core license revenue recently, and a fundamental reliance on actually securing those big new deals. There's significant execution risk.
This kind of strategic shift, it's always tricky. Reminds me a little of other tech companies that tried to move from one model to another. Sometimes it works spectacularly, sometimes it fizzles.
It's a high-stakes game. Success often boils down to how unique and valuable the tech truly is, and the team's ability to execute, build partnerships, and manage finances through the change. Neonode is definitely at such a juncture.
So to really bring it all together, Neonode, EON, it's a compelling story, but it's complex. You've got this innovative tech, this strategic shift towards licensing, especially in auto, that offers real growth potential.
The potential is there on paper.
The leadership changes, those early project successes, they seem to support the new direction.
They provide some positive signals, certainly.
But then you weigh that against the current financials. The revenue dip in the core area, the ongoing losses, these highlight the very real challenges still ahead.
Can't understate those challenges.
For investors already holding the stock, one source we saw suggested a hold, basically. Wait and see if more concrete, positive financial data emerges.
A cautious stance? Understandable given the uncertainties.
For someone considering jumping in now, it might be seen as a buy, but only with a very clear understanding of the risks involved and the likely longer time frame needed to potentially reach profitability.
High risk, potentially high reward, but patience would be essential.
Which really brings up a key question for you to think about. How comfortable are you personally investing in a company that's right in the middle of this kind of major strategic overhaul, with all the associated risks, but also the potential rewards if they succeed in these specialized markets?
We hope this exploration has given you a clearer perspective on Neonode. As always, please remember, do your own thorough research before making any investment decisions. This is just our breakdown of the information we had.
Absolutely. And if you found this helpful, we'd appreciate it if you'd subscribe, like, and maybe leave a comment. We do read the feedback.
We definitely do. And maybe one final thought for you to mull over. We're talking about automotive, industrial, medical. But given the growing demand for sophisticated HMIs everywhere, what other, maybe less obvious niche applications could Neonode's zForce technology be really well suited for down the road? Something to think about.